Okay, we're going to have another great conversation here. We have David Schwimmer, CEO of the London Stock Exchange Group. And David had spent 20 years at Goldman before moving on to the London Stock Exchange Group. And I'm, David, most grateful to you because you and your group have been major supporters of the center for many, many years. And thank you. And we value our partnership and hope we can continue it. We're delighted to have Gillian Tett here. Gillian is the chair of the editorial board and editor-at-large US for the Financial Times. Again, the Financial Times is a partner of the Pissarro Center. And during the coffee break, Gillian will provide signed copies of her book, Anthrovision. Right? The buzzword for this at universities is interdisciplinary, right? Where it's not just finance can do things on its own, but you need to bring a team together from many different disciplines to work on the important issues. So we will have copies of the book available for you, and Gillian will sign them during the coffee break. And with that, let me hand it over to you, Gillian.
Well, thank you very much indeed. I think the buzzword is actually go hug an anthropologist. If you're in finance, they're not all weird and hippie. In fact, they have quite a lot to teach you. So there we go. Anyway, on behalf of the Financial Times, I should start by saying I'm truly delighted to have a chance to be here today and that we are partners with you for this event. We are fundamentally paid up geeks at the FT. We are passionately interested in how money goes around the world. And we try and write about it in as fair and accurate and technocratic and geeky way as we can without necessarily taking political sides. And I think that's very much what you're doing here at the business school. So any of you who are reading the FT already, thank you. If you're not yet, please do. And it's wonderful to have a chance to, above all else, talk to David, who, like the FT, is headquartered in London these days. There was a time when the UK political economy was famously boring compared to Italy. Anyway, I joked early this week on British television in a clip that went viral that the UK had become like Italy in terms of the financial risk, political instability, and policy uncertainty, except without the food, fashion, and sunshine. And at that stage, UK yields were actually higher than Italian ones, and the level of, most importantly, liquidity in the gilt market was actually worse than Italy, according to the Bloomberg Index. Again, we're all paid up geeks here, so you all know what that means. But it's been an extraordinary time. In the last few minutes, as we were preparing to come on stage, I was tracking what's been happening right now. There's just been a press conference, for those who don't know. Kwasi Kwarteng, who I had dinner with last night here in Washington, is now sacked. Jeremy Hunt, someone who is commendably pretty boring, has come in. Unfortunately, sterling has fallen. Gilt yields have gone up again, even though everyone's expecting a dramatic U-turn, which suggests that confidence is not that high, not least because there's now a cabal of Tory MPs who are trying to push out Liz Truss. So watch this space and read the FT. But it's a good way of me coming to you and saying, so tell us, how has the London Stock Exchange held up this week?
Thank you, Gillian. In all seriousness, Rena, thank you very much. And it is great to be here and great to be here with Gillian. We're going to do our best not to go viral in this conversation.
Oh, why? Speak for yourself.
Yes. So with respect to, I'll answer that with respect to both the London Stock Exchange, but also with respect to the London Stock Exchange Group. London Stock Exchange, great institution, 300-year history, iconic financial entity. and critical to equity trading in the UK and across Europe and in other parts of the world, the most international equity financial center in the world. The London Stock Exchange, many people don't know this, is less than 5% of our revenue. So with respect to the London Stock Exchange Group, we do many, many other things. Just to break it down very simply, in our capital markets business, we, in addition to being an execution venue for equities, we are one of the world's leading execution venues for foreign exchange and also for fixed income, where we are the controlling shareholder of a business called Tradeweb, listed here in the US, leading electronic execution venue for fixed income. We are one of the world's leading providers of financial data and analytics on a global basis. Number one provider of, for example, real-time pricing, but many, many, many other aspects in terms of data and analytics. And we are also one of the world's leading providers of clearing through LCH, London Clearing House, which is the most important over-the-counter clearinghouse in the world. And that actually comes back to your question, where we do clear sterling repos. So UK government bonds. We also clear euro-denominated government bonds and other government bonds as well. But it's actually a very interesting policy question. You said we're all market structure geeks here, so I can go into this. There has been an evolution in the clearing of number of different asset classes, but there's a mandate to clear interest rate swaps, which has been evolving into place since the Pittsburgh G20 in 2009. But there has been an exception in Europe for the mandate to clear swaps by pension funds. Now that exception is ending, I think, June of next year. But how does that connect to all of this? The reason there was an exception for pension funds is that they didn't want to have to keep the cash on hand to meet margin requirements in the context of a cleared asset class. And now we've solved that issue by allowing for the clearing of repos, so that pension funds which are sitting on government bonds can go to the repo market, get cash, use that cash to come up with collateral in the swaps market. But a lot of pension funds have not yet taken advantage of that yet.
So what you're basically saying is that if only the pension funds had been wise enough to avail themselves of your wonderful services, none of this would have happened.
I think the liquidity could have been made available much more easily than by going to the repo market than by being forced to sell gilt.
So when do you put the LDI disaster into your marketing brochure?
It's probably not the way we're going to approach it. But I think one thing that we do talk a lot about is our focus on financial stability. And this is a great example of an area where in really a corner of the market that very few people were paying attention to, mm-hmm. And that was not perceived to be a source of risk, and certainly not seen to be a source of systemic risk. What we have seen is, with a few different events and some bad policy and some bad judgment, it has really triggered a very difficult situation, both for the pension funds themselves, but the UK government. And this is going to have an ongoing impact in terms of the UK economy, in particular because of the impact on interest rates and what that will do to mortgages, et cetera.
Yeah, I mean, I often say, I ran the financial markets coverage for a number of years at the FT, and I always said it's good to be a geek because things like plumbing get comprehensively ignored because they're so geeky most of the time. But, financial market plumbing is like real world plumbing in that you ignore it when it's going right, and when it goes wrong and backs up and creates a mess, you suddenly start to care about the finer details of the stuff that you ignored. But I have two questions in relation to what you just said about pensions and the lack of clearing and the use of repo and collateral. Firstly, do you expect that they're all now going to be signing up enthusiastically to your wonderful services on clearing? Have you seen any of them knocking on your doors yet? And secondly, Why the heck did nobody at the Bank of England spot this before?
I'll focus on your first question.
I'd love to get an answer to the second, though.
So one of the issues in the with the pension funds in the UK is that a lot of them are fairly small entities. A lot of them haven't had to do much. They haven't had to be sort of front-footed in terms of collateral calls.
You mean they were the kind of sleepy B team?
I don't know if I would describe them as B team, but in terms of the requirements of the job, it wasn't that demanding. And then for them to get a call in the morning and say, we need, X million pounds of collateral this afternoon, they just weren't equipped to operate in that way at all. And then there were some, in terms, you talk about plumbing, it's been reported that some of the custodians that have been working with them as well also had some operational issues and operational challenges in terms of being able to move that quickly. So again, it highlights what I think is an important point, and you could talk about this in the context of the LDI crisis. You could talk about it on a broader basis, and this is something that we take great pride in being the plumbing of the markets. And if you think about how the world has changed over the last, call it 10 or 15 years, you've had a dramatic increase in the electronification of trading across all different kinds of asset classes. You have had a dramatic increase in algorithmically driven trading. And so what that means is that you can see massive both spikes in volume and market moves in a very short period of time. So that all exists on the front end of the system, if I can put it that way, in terms of the execution venues. But I think the middle and back parts of those systems haven't really caught up with that. So you can see big moves, big spikes in volume, and then as it works its way through the plumbing, again, to use your analogy, that it can create a real backup and a real problem. And I think as we see more types of volatile events, we'll probably see that kind of trend in a number of different areas. We saw it in March 2020, where a number of banks, a number of the CSDs in the settlement space, they wanted to shut their markets. They needed to catch up over the weekends. So we might see more of that.
So where do you think, I mean, by the way, I heartily agree. I am going to come back to the Bank of England in a moment, but before I do, I want to ask you, where do you think the next big mess, to keep with the plumbing analogy, is going to happen next? Where is most vulnerable in terms of the next mess? Because we've had peculiar flash crashes emerging repeatedly in equities. We've had flash crashes in commodity markets. We had, the mother of all flash crashes in March 2020 in the treasuries market. Chairman Gensler observed earlier that had created extraordinary challenges, partly because, only 13% of cash treasuries are cleared, or were a year ago. So when you look around the world today, where do you think the biggest potential mess is going to emerge next?
I think there is a possibility of some real challenges as we go through increasing volatility, as we go through higher cost of financing, rising interest rates. A part of the economy that is not particularly transparent, and this is not an area where we have particular insight because we don't do a lot in it, is private markets. And there's been a huge growth in private markets activity. There's a lot of leverage in private markets. I think valuations have gone up and up and up, and in some cases gotten pretty unmoored from more fundamental views of valuation. And this, you could take this back, you could take it back 10 years, you could take it back longer. It depends on how you think about that in terms of having had a real correction. So that's an area that I would say gives me pause when I think about it. And it's, again, by definition, it's not as transparent. So hard to know what's going to play out in that area.
Right. Well, I read a column last week looking at 4 flashpoints that I thought could be some of the next flashpoints. And in fact, one of them I did point to was the private markets, because, you know, supposedly all of these wise private equity and venture capitalists are writing down the value of their assets in line with changing economic conditions, except we kind of don't know how much they're writing them down yet. So I agree with you strongly on that one. But coming back to the question of the blockages in private markets and cleared markets, how much of the crises we've seen in, say, let's just start with, you know, the government bond market, the Treasury's crunch of March 2020, what's happened in gilts now, how much of that is due to the decline in market makers as a result of the post-2008 financial reforms? And how much of that is due to other issues to do with technology, in your view?
I think it's hard to put any kind of precise percentage on it. But I think clearly you have seen the big banks move out in terms of some of the capital issues, in terms of their market making in those areas. I think you have seen a number of new entrants come into those markets.
The algorithmic traders.
Mm-hmm.
Yeah.
And so this is an issue that a number of whether it's think tanks, stakeholders, regulators are looking at. Certainly here in the U.S., it's something that we don't clear U.S. government bonds or repos. We do clear. We have a very high percentage of the market in terms of clearing, for example, euro-denominated government bonds, in addition to sterling. And it is an area where we have found that to have that be a fully cleared market works well. I touched on some of the dynamics in terms of the pension funds and the exemption. I think it'll be helpful when that exemption goes away next year. But we're watching what's going on in the U.S. And it'll be interesting to see what kinds of changes are put in place in this market. I think.
Well, you're basically saying the US should copy Europe.
I think in that area, there are certainly some lessons to be learned. Yeah.
Okay.
Yeah.
I mean, the US doesn't have a long history of copying European regulation, but that will be interesting.
Yeah. It's, I think that, look, there are lots of issues, lots of complexity, lots of nuances around what the right model is and what the right construct is for the Treasury market and clearing of that market. And in some ways, parts of it are cleared now, but I think there's some issues to work through there, but I think it can be done in a way that makes it a stabler, safer, more resilient market. And when we're talking about the US Treasury market, that's a good thing.
Well, yeah, I mean, I guess the question I have is, can we get from 13% to 80% fast enough before we have some kind of crisis erupt in US government debt? And to me, the answer is not clear. Do you have a view?
I am not in a position to answer that one either. I think that there are a lot of people focusing on it, a lot of people thinking about it. As I think we all know, sometimes the wheels of reform can turn pretty slowly.
You're not tempted to jump in and suddenly offer a whole bunch of new US bond clearing services?
I think one of the aspects about the role we play in the markets and what our competitors or peers do as well is these are very complex ecosystems. So we could, set up our business over here and kind of put a shingle out and say, here, we're ready to clear. As you know very well, it would take years just for the relevant market participants to connect to us. So
I'd like to come back to the question of Bank of England, because Paul Tucker, Sir Paul Tucker, was the former deputy governor of the Bank of England. And he's someone I know well because, as I've written in some of my previous books, he was in charge of financial market stability when I was looking at the financial markets team inside the FT in the run-up to the 2008 crisis. And he has been warning for many years, most recently in the summer, that there was going to be a nasty accident. He has repeatedly pointed out to the loss of market makers and warned that at some point, the central banks will have to come in and be the market maker of resort in the markets. So you can't say, or other people can't say, I'm not saying you say this, but other people can't say that nobody knew about this looming problem. So why are so many bright people so blind and so stupid sometimes?
Well,
I mean, I try to offer an answer in, my last book. I would say anthropology, tribalism, cultural patterns, incentives have a lot to do with it. But that's my view. But
I think, and you see this in markets, and you see this in lots of different areas of human interaction, is that people get accustomed to conditions. And we collectively, macroeconomically, have gotten accustomed over the last 20 years to what is really a historical anomaly in terms of how the markets should be acting and how central banks participate in the context of the markets. I mean, there is an entire generation of market actors, whether traders, investors, capital raisers, people who are trying to learn how to value, all of that has been, I think it's fair to say, distorted over the last, and again, it depends on how you want to measure it, but I'll say 20 years. And there are people who have had very successful, for example, asset management careers because they've benefited from the Fed put. And they're not sure how to operate in a world where there is no Fed put. So I think, just to kind of emphasize the point, we had negative interest rates for years. Negative interest rates are crazy. And yet that was normalized for years. So my only point of this is that sense of normalization, that sense of people's senses were a little bit dulled. And if you took a step back, then there had to be a recognition that this time period was unusual and an anomaly, and that there was going to have to be a time period when it was going to change. And here we are now, interest rates are moving 5%, 6%. That wasn't a big deal 20, 30 years ago at all. And the world functioned and operated. It's going to be a huge deal for now. And it will be a very difficult adjustment in a number of economies. And then we'll adapt to that. So I don't think people are stupid. I think people are sometimes short-sighted and have short memories about these things, and they get used to the conditions around them.
Well, I'll put it slightly differently. And in fact, that's what my last book, Anthrovision, is about, that basically, human beings, wherever they are, whether they're in the Amazon jungle or an Amazon warehouse or on an Amazon board, everyone thinks that, the assumptions we've inherited from around us are natural, normal, inevitable, and unchanging. And they never are. And the Chinese have a wonderful proverb: a fish can't see water. None of us can see the assumptions that blind us unless we periodically jump out of our fishbowl, go talk to other fish, and then look back at ourselves and see why bright people are so stupid and so unable to see how their vision is clouded by their assumptions. And I think you're absolutely right that, and I write about this quite a lot, that the last 20 years of zero rates have seemed to be normal, and they're anything but. Do you have, I'm going to turn to questions now from the audience if we have time. Do we have time, Rima? I think you have to come up and stand at the mic. And I would once again like to give priority to any students, because if they're brave enough to stand up and ask a question, they deserve to be given a good mark. But secondly, because I think it's great to get a chance to get the next generation to say a few things or comment a bit or ask questions. How much time do we have? 2, 3. Oh, goodness me. Okay. Can we go on? Can we get a couple of questions in from the students, if anyone wants? Anyone brave enough? You've terrified them all already. Well, let me say, since no one's asking any questions, let me turn around and say this. Have you got any advice for anyone who's starting out in finance today, other than go discover the joys of clearing and or work for the London Stock Exchange Group?
I would just say, people often, and whether this is in financial markets or many other fields of endeavor, to the students out there, don't set your own limits. In other words, people often choose not to go after things or don't even attempt to do something because they think it's beyond them. And I think that's a dangerous thing to do in terms of your own potential and your own opportunities. So don't set your own limits would be a comment I would make for the students that are here.
Right.
So.
And any advice for the British government as it tries to restore credibility? Other than also go discover the joys of clearing.
Yeah. I think we've seen this in the UK, we've seen it in the US, we've seen it in other governments and other economies. This sense that somehow sort of an anti-intellectual bent, and it's tied in with some of the populism that we've seen out there, and that's a much broader issue than our markets, but it obviously has a big impact on the markets. So I think the notion of really trying to appeal to populism with this anti-intellectual bent and sort of saying any kind of market orthodoxy must necessarily be cast aside is just a very dangerous attitude because sometimes the orthodoxy is wrong. So you certainly have to keep an open mind and be thoughtful about that. But sometimes it's worthwhile listening to people who have experience in these areas. And sometimes the markets are a pretty good disciplinarian.
Well, I think that's one way of saying or re-saying the Financial Times' mantra, which is that it's good to be a geek. So thank you very much indeed. And good luck for next week. Thank you.
Thank you.